Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed
Drew Meredith,
program.
welcome to this Australian Investors Podcast 2 Cents episode.
Good to be here, as always.
It is very good. There was a bit of a pause there, a bit of an awkward pause. It's always hard to start, you know?
Definitely. There's this cold Melbourne weather. It was a bit of a surprise when I was out there before.
Yeah. It's like kickstarting an old XR100 motorbike. Like, you're just like, come on, baby.
Not quite ready. We are recording on a Wednesday, which is probably just put me off a little bit.
Yeah, it's hump day. Everyone's just a bit confused. What have you been working on?
A bit of everything. You ask me this every week, and it always puts me under pressure pretty quickly. Trying to work out what's going on in markets like everyone else.
Whoa, what an answer.
About to head up to Sydney next week.
Heading up to Sydney next week for
my flights.
Yep, for the event. Tuesday night. If you haven't already got your tickets, for you and friends and 10 friends maybe, get your tickets to the Sydney event, Tuesday night, 5:30 p.m.
How many are we up to?
I'd have to be, I don't know, I think maybe 200 plus, maybe. I don't know exactly. Mel's probably going to shoot me down for that. But
you know I love a crowd, right?
Yeah, you do. the ultimate entertainer.
The most confident public speaker in history.
Top 2 buttons down. It's going to be a great night, and we've got some really, really wonderful speakers, plus us too, up on stage. So it'll be a bit of fun, and I'm really looking forward to it. So it's the last of the 10 Rask Roadshow events, mate. And then on the 26th of October, for anyone that is in Melbourne or wants to fly to Melbourne, there is a Wattle Partners retirement event, 26th of October, afternoon shift, isn't it?
Afternoon shift. I think it starts about 2:30, 3 o'clock. Some drinks afterwards at Le Meridian in the city.
Oh,
I think we're capacity about 120, and we're up. I think we've got about 30 seats left.
Wow!
And some investment speakers as well as a retirement coach and.
Yep.
And us.
Yeah,
as always.
We're dragging ourselves along to it. No, but it's going to be great, and that's free. So just to reiterate, the retirement event in Melbourne is free. There isn't at this stage, there isn't another one on the horizon, but we probably will have them next year. For the Rask event, this is the final Rask event of 2023. Some of you have also realised we're doing a workshop the following day in Sydney for value investing. There aren't many tickets left to that. That's taking place at the Magellan offices. It is a paid workshop, a full day workshop. So please get your tickets basically now if you want to come to that next week. Bring your friends, bring your family to the events. It's great fun. So
there's big news outside of investments this week too, wasn't there?
What was that?
Brownlow medal.
Oh, that was on Monday night, wasn't it?
It was
Who
Monday
won?
night,
I didn't even know.
I almost fell asleep before the end too.
Who won? Tell me.
Lockie Neal won.
Oh, did he?
As a Bulldog supporter, there was Marcus Bontempelli came second. So
really?
I'll raise that. And then we had the Premier League yesterday.
Dan Andrews. Yeah. Commiserations.
There's a massive legacy of infrastructure there. Like if you look at what Dan Andrews will be remembered for, it'd be a massive infrastructure build that's
or COVID
changed the city. Yeah, we try to be positive. We don't have to be political on here. But, you know, level crossings, freeways, tunnels, it's a massive build over 9 years.
Yeah, I think the thing is, like, a lot of people are focusing on the negative around the budget, but there has been a lot of spending. Like, if you're in Victoria and you do go down towards the peninsula and you start driving down the bay, you see, like, the railways above, above MMT ground. Anyway. It's incredible. MMT, modern monetary theory says true.
As long as it's being used for productive capacity, then...
it's a good thing.
Yeah, exactly.
Yeah.
Traffic suggests it may not be.
No, but we have seen a lot. I think one of the things that gave me the irrits was the probably like we didn't get that the proper freeway connection in Melbourne. For anyone that knows Melbourne, you just get to the end of the freeway.
On the freeway, you just sit there and go, oh gosh.
Get into the freeway in Melbourne and it just goes nowhere. Like it just stops straight in the busiest part of the city. You're like, where are we?
That's why podcasts are so popular in Melbourne, not in Sydney.
Yeah, that's it. Yeah, but no. There's been a lot of news. I did speak to JP Morgan last week, one of the global bond fund portfolio managers actually, and over in the US. they're expecting it's an when, not if, and not imminent, but they think a recession is very, very close to certain.
It's a tough call, though, isn't it? Like, we've been talking about a recession for at least 12 months, and we're still waiting for it to happen.
Yeah. Yeah, I mean, hard, soft, however you like your tacos. Same with recessions.
Or no landing. Can you have no taco?
Yeah, you have no. You don't have to eat it. Yeah, carb free. But at the end of the day, like what they're expecting in the United States is that rates are pretty high over there, and they've gone higher recently, but it is having an impact.
Yeah, it's not looking great for me. I'm not making a bet on the Federal Reserve making a move, but bond yield, so the 10-year bond yield, which is basically the risk-free rate that off which every other asset is valued, hit 4.7%. So it hasn't been that high since immediately before the GFC hit in October 2007.
So what does that mean?
I mean, it means that valuations, whether it's property or shares, are probably at risk of falling further. And then the market's telling us they expect interest rates to stay higher for longer, and that inflation might be a more sustained problem. And all that came from the Federal Reserve Chair and I think another member of the Federal Reserve saying, we don't intend to cut rates in 2024. But then I naturally go back to what all of them said in 2020 and 2021. We don't see ourselves increasing rates.
Oh, look at this.
It's transitory. So it's kind of the role of a central bank is the communication. They're still trying to slow demand. So I think this is a big part of that. And naturally, the share market and the bond market react immediately and quickly. But as you've seen, they adjust just as quickly. So if you see any bad news, bond yields will fall as fast as they increase.
I was actually reading something yesterday. I think it was like the BlackRock long-term macro assumptions.
Yep.
And they do like 3, 5, 10 years. It's mainly for institutional readers only, but there's one in the US, and it showed that, I think, just going off the top of my head, sorry, BlackRock, it was like they expect the total return from bonds to be about 4 to 5% from memory, but they said for small cap US equities, about 5.4% over 3 or 5 years.
Yeah.
And so if you think about I think it was 4% versus 5.4%. So 4% from bonds, 5.4% from small cap equities. When you think about the share market and the risks involved, you're only getting 1.4% for the extra risk.
This is the whole challenge we have when we meet people, and it sounds boring, but you can take less risk than ever, and you have to be really justified in doing anything beyond cash or term deposits. And all be taking a very long-term view. 3 years is pretty short.
In your portfolios at Wattle Partners, retirement wealth specialists, by the way, I might say, in your portfolios at Wattle, are you guys using any floating rate?
Yeah, we were 80% floating to 20% fixed until recently, and then in 2023 we've made it 50-50. So we're half floating, half fixed.
Yep.
And we're probably given yields. The income you can get from a government bond is over 4% now. We're looking at increasing the fixed rate more, which is somewhat contrarian or the opposite of what a lot of people are talking about. But I think that just tells you we're taking a longer term view. And we also think if you can get 4.5% risk free, rates have to go up a lot more to lose much money on that.
It's interesting. Like one of the fastest growing funds of the last year in ETF land is the Global X Treasuries Fund.
Yep.
Which is actually down year over year, like 6% or something.
Yep. That's short term.
No, this is long term, long duration.
3, 5, 10 year US government bonds.
And because rates have still gone up a little bit in the US, they're still losing. I think the duration, we're going to get some geeky stuff out right now. Have a look in my toolbox. But here we see that duration was around about 6 and interest rates have gone up maybe half that, maybe a bit more since then. So we've seen the portfolio fall about 6.
Yeah.
So just so you know, for anyone that's listening and doesn't have a clue what that just meant, if you go onto a bond ETF's website or bond fund manager's website, they'll have something called effective duration. What that basically means is it's an assessment of the sensitivity of the fund to interest rate changes. So for example, if it's 6, what that would mean is if interest rates go up 1%, you'd expect the bond portfolio to fall 6%.
And interest rates not being the cash rate that the RBA uses, but the bond yield, the prevailing bond yield.
Exactly.
Of the similar term.
Yeah. So you can get a sense of like what it actually means. And so when you have long duration, like you'll have 10-year government bonds, let's say the effective duration is 8, they're more sensitive than something that's got no duration at all, which would be like floating interest rates. Might be a floating rate fund, a floating rate ETF might have a duration of what, like 0.2, meaning that it's basically immune to changes.
Yeah, exactly. And then if you see bond yields, what we've seen, if there is a recession, what has happened in every recession is bond yields have fallen quickly.
Yep.
So they can fall from 4.5 to 2.5 in a week or less if people are buying up bonds because they think it's going to offer protection or they want to get out of equities.
Yeah. And what we've seen is people starting to buy those bonds.
Yeah.
That was kind of my point and your point is like people are now starting to do that. And they've been hurt in the short term because interest rates have still gone up. But you can see financial advisors, big institutional investors slowly moving their money into fixed rate bonds.
I think that's why the Global X product's so popular. Is there aren't, I think there's only one other option to buy that sort of exposure. So people are more and more thinking about line by line the exposures within their portfolio rather than just buying someone does all your asset allocation, or they're thinking about they can add Australian government bonds and US government bonds separately.
Yeah, which is interesting because normally it would just be like VBND or like some of those big global diversified bond funds. So now you're getting, oh no, I just want more US, or I just want more, for whatever reason you might be inclined to do this, Europe or whatever.
And there's a big story that came, which Animal Spirits were talking about when we're in LA, which is the issue. I think there was something like 30% of all government debt matures in the next, US government debt matures in the next, I think 1 to 3 years. And if you got debt maturing that was, on a 3% interest rate, and now you're offering it, you have to now raise it at 4.7 for a 10-year bond. What impact is that going to have, one, on the government, on the economy, on policy going forward? A lot of people think that that's a reason why interest rates will end up falling, because the interest cost to the government will be too high.
Then what happens to inflation?
It's deep.
Then what happens to inflation?
Exactly. You need to take more money out of the economy, and essentially that's what you're going to be doing.
Yeah,
because the government will spend less. Not that they're restricted to, because I know Bill Mitchell will listen to the podcast. They're not restricted to doing that, but it wouldn't surprise me if they do, and they end up trying to run surpluses.
We should get Bill in here one day just to educate us on how all this stuff works.
I asked him; he's happy to. He's in Japan, and he'll do it. Yeah, we can do Restream anytime.
Okay, right. We'll get him to dial in. Okay, so I've got a question for you. Is everyone about to go broke? Because household savings, this is one, I'm just going to pull this one figure out of the air that I just look at a lot. Household savings is
negative,
very low compared to any average over basically at any time leading up to the GFC. At that time, household savings was quite low because the interest rates were 7-8% or whatever. But household savings very low, coming off record peaks.
Yeah, but I think the people that are spending, and we've gone through this, I think Alan Kohler, maybe
he
put this
singled out the boomers, didn't he? Yeah.
But I think the household, maybe the saving rate doesn't include the people who already have money.
Yeah.
They're not generating income.
They're not getting income.
Yeah, but they're the ones that are spending and creating inflation. Thanks, boomers.
Yeah. Just a bit of...
But essentially, I think that's what he was talking about with this idea that the people who have significant savings are in retirement and are getting higher interest on their income, they've got more to spend and they're not included in the savings rate. Whereas the younger people with mortgages and in early parts of their career are saving less just to keep up with the higher cost of living. So I think maybe that's where this, none of these measures are completely perfect.
Yeah.
I've annoyed both sides of the...
Yeah, well, you do. You just had a fight with everyone, picked a fight. Damn you, Burmans. Damn you, young people.
Wednesday.
And I just took this one photograph of the savings ratio, which shows a big drop off since COVID. But people are obviously spending, saving money during COVID because it's the perfect time, right? You had an inability to travel, an inability to spend literally anywhere other than online, which was good for Zoom stock for a little while, and then that didn't work out so well. The other thing that I'm curious, because
put that against the S&P 500.
I could do any type of chart crime you want me to do, really. A curious question for you then. Do you think at this stage of the cycle, do you think we'll start to see more... I feel like we'll start to see a lot more stress in small business and private businesses, meaningful.
I think you've seen it initially focused on the property and construction sector, where there was a lot of providers.
Yeah.
And it's spreading into the commercial property at the moment. But small businesses, you can just go to your local cafe and you can feel the kind of stress filtering in.
Yeah.
Whether the customers are still there, prices are going up, staff are going up. It's probably harder to get staff.
Yeah.
It wouldn't surprise me. That's kind of good indicator of what's happening in the economy, isn't it?
Yeah. Like you said,
Instagram and everyone going to Europe is probably another.
Yeah, that's a bit of a different one, yeah. But I think for a lot of small businesses right now, a lot of them would maybe have had their eyes closed to some of the financials over the past few years, and now they're waking up and they're saying, wow,
out of your own pocket back into your business.
Yeah, and this is out of shape, this thing. So
I mean, if like Lululemon and the big retailers are being forced to discount, I'm sure smaller retailers are as well.
And you see this in like the brokerage space. Some of the platforms like ComSec dropping their fees to compete. Even Self-Wealth dropped their fees. Like if you just think about that from the investment lens, that's probably a very like strong signal to the market. Like we see the weakness in the market. We're going to go after this now. Yeah. Had a chat with Rob from Self-Wealth about this not too long ago. I just feel like there's a lot of, I think if you're a venture capitalist who managed to raise money at the top, like maybe if you raised money 18 months ago and you haven't deployed, like I feel like it'd be happy days right now.
Venture capital fund.
Yeah, venture capital fund.
Yeah. Not a company that's...
No. There's some struggle down there.
Some numbers around that. There was like 99% of private business or venture capital businesses fail. But then there were some stats that said the likes of Airtree and Blackbird, it's much lower. Like only 20%
It'd have to be
of the companies they invest into.
But if you think about it, like they have... not just those two, but just in general, if you did raise at the right time, all of a sudden you have less...
No competition.
Lower quality businesses going out of business because they just unfortunately can't afford to keep going without cheap funding.
Milk Run was in a store that's owned by Woolies now, isn't it?
Yeah, great ads on the billboards, I might add, though. But then you have like so lower competition, better deals, and more flow.
Yeah.
So like you get this wicked combination of like in the next cycle, I don't know, this is how I'm thinking. I don't know how you think about this, but I'm not in this world, but that's what I'd be thinking about.
You're ready to deploy.
Yeah.
I think it's everywhere. And it's not just, maybe there's great opportunity in venture capital, but
small cap stocks
deploying in property in the next, even just looking at listed markets at the moment, there's massive discounts to NTA in listed markets, but commercial property, you're going to see, you already are, all kinds of deals for people that have cash and can take a 5-10 year view, not a 6-12 2-year view.
Oh, absolutely.
Dislocations occur when things like bond yields hit 4%.
I think this is like a part of the cycle that a lot of people forgot about.
Yeah. But the most share markets haven't responded really all that much yet.
No, they haven't, and that's why the bond yields are really interesting because, like, if you have the choice of a government bond over stocks for 10 years, 4.5%, like it's a pretty good deal.
Definitely, at least for a portion.
Yeah, a portion. You wouldn't go all or nothing just in case inflation continues above that.
And what has to go wrong for bonds to have negative returns?
Yeah,
you basically have to see another doubling of bond yields from 4.5 to 9. That's just a guess, but to lose all the income that you're going to get from those bonds.
Conscious of time here, Drew, but Pro Medicus came out with a blockbuster deal.
He's never conscious of time.
Pro Medicus came out with a big deal. I'm going to bring it up yesterday. Thank you to Claude Walker from A Rich Life for pointing me to this. I got about 15 notifications on my phone, but didn't look at any of them until the end of the day.
Wasn't that big a deal, though? Is it just the confidence that comes with another major contract?
Well, it's the confidence that comes with a 10-year deal. I think that's the key thing here. Yeah. Like a lot of the deals that they sign are like 5-7 years. This was a big deal in Texas. Pro Medicus being the medical imaging company from Victoria. Actually spoke to Sam the other day via email. Sam, if you're listening, I will get back to you. So Sam being the co-founder and CEO. Signed a 10-year contract with Bayer Scott and White Health in Texas. It's a $140 million deal over 10 years. Now, you're right. Pro Medicus has hundreds of millions of dollars already baked in over the next few years.
Yeah.
But the 10-year deal at this stage of the cycle, what it means is like people have been really pleased with Pro Medicus because it's always seemed like it's 18 months to 2 years ahead of the competition in terms of technology. And despite being the most expensive, all the hospitals keep signing up with them.
Yeah.
And they basically don't lose tenders for these hospitals. But what this basically says is it probably squashed a lot of fears that people have around, or investors have around, well, has the competition caught up? Like, has Fuji caught up? Have all these others caught up with you? To then get a 10-year deal, huge.
Yeah.
Massive. And for the full stack, for all the products, basically, is like, that's just a massive endorsement of the business. Is it overvalued? Probably. Would I buy it today?
What growth company isn't?
Well, that's it.
And I think this is a reminder. And growth, earnings growth, revenue growth, cash flow growth, when interest rates are going up, it is actually more important. You know, they talk about growth companies being bad in high interest rate environments, but if you're actually growing earnings, that's hard to come by in this type of economic environment. So it'll just become more and more valuable. Likewise, CSL in any recession or difficult period tends to outperform.
Yeah. The thing what you're alluding to is there's there's two sides to this. There's the one where your shares get sold off because your valuation is higher.
Yeah.
But as long as it grows through the cycle, then you get the uplift when you come out the other end.
You get a PE re-rating at some point.
Yeah. And that's the difference. So it might be short-term volatility for sure. But let's be honest, like Pro Medicus is extremely expensive. Like by all conventional metrics. But it is a great business, absolutely. It's one of the best in the ASX. That's why it is so expensive.
We've got inflation data coming out today too.
Yeah. What time does that drop?
Wednesday, so that'll have to be next week's.
We're recording this about 11 a.m. So what time does it come out?
I think it's usually 1 or 2.
Yeah, right. Okay, so we'll find out more. But that will be a big tell for what happens with the market. There is still fears that interest rates may go higher here.
Yeah, it's easy to write that, isn't it?
Well, it is. Yeah, it is. So it's a scary thing. When I did a poll on Twitter the other day, the number one thing that people were scared of formerly known as Twitter, the number one thing that investors were worried about, inflation.
Yeah.
Not like recession generally or not house prices, it was inflation.
And that's kind of, you're seeing that in Qantas and Air New Zealand, you probably saw this week. Qantas has its own issues.
Oh, yeah.
But they warned of about a $200 million hit from higher oil prices. So oil prices are good for the energy sector, but they're bad for every other part of the economy. And part of the driver of inflation falling off was energy prices falling at the same time. But now you've got US, I think nearly $90 a barrel for oil again. And Air New Zealand refused to provide forecasts because they didn't know the entire impact of aviation fuel and energy costs on their business.
Hypothetical.
But they did promise not to increase their flight prices, I believe.
Here's a hypothetical for you.
Yeah. A pre-prepared or an extra one?
No, this is an extra one.
Oh, God.
Would you rather be the CEO of Qantas right now? Like, bada bing, bada boom. You walk out of the studio, you're the CEO, Qantas, Air New Zealand.
I think Qantas, because there's only one way you can go from here.
Take off.
Yeah, you can only go up from here.
I don't know about that. That's just some famous last
You want to
words.
know if there's anything left in the cupboard. But because, it couldn't be much worse. And they've finally got someone, I think CSLA put a sell on them this week. They've had energy price going up. The CEO's moved on. They had misleading, deceptive conduct. They've allegation, and the High Court Fair Work decision as well. So But I did buy a Zip when it was falling, so maybe I'm just that person attracted to a falling knife.
Actually, yeah, we did. I did send Drew a few screenshots this week of like how bad.
Thanks for the reminder. I was already having a bad day.
Some of our investments gone, not just yours, but mine as well. You can only just sit back and just, we've all got a bad habit for those growth stocks.
Yeah, maybe you just like something that's falling. It feels like you can save it.
Yeah. So you actually came to the table, I think, this week with hypotheticals.
I did put some hypotheticals in.
Yeah, normally I'd give you the hypotheticals. So what you go, okay, you read the first one, then I'll read the second one. You go.
200, there's drugs in here? Sorry.
Yeah, sorry, go for it.
So I thought an interesting one, and we'll try to go outside the golden rules that I always talk about, which is what are the 2 investing rules? I had 3 or 4, but I think just narrow it down to 2. 2 investing rules you live by every day.
Core and satellite, for sure.
Yeah.
First of all, being the core is like low-cost, boring, diversified strategies.
Yeah.
But also appropriately managed. I think that's the big thing. The second thing in the satellite would be like they're higher risk. Most people that listen to the show are going to buy individual shares. Our research tells us that over 80% of us already do own individual shares that listen to this show. So most of us do that, but just have a balance. Like know what's in your core and what's in your satellite. Just have that very simple thing. You do that with clients. You have strategic asset allocation, and they might come to you with existing portfolios that they just do not want to sell. How do you manage that, for example? But what's your number one?
My number one is think global, where we tend to, I don't know, so many clients and people we talk to tend to be too focused on buying Aussie shares. Yeah, franking credits are great, but the quality of businesses overseas, I'd much be preferring to buy Apple over Xero, for instance. Not saying either company is bad, but as a comparison, it just doesn't compare, and even the valuations are completely different.
Yeah, that's true.
Let's think global, and maybe that's just rote learning, having to explain it so many times to people. And probably similar to yours, it's in investing, it's and not or. Like there's no simple rule that works for everyone, and it can be core and satellite, as you said. It can be value and growth. It can be ETFs and funds and stocks. Yeah, it doesn't have to be one or the other.
That's so true.
Sometimes we get too stuck in this. We only do it one way.
So global and I like it.
And
My second one would be, so if my first one is like the core and satellite approach, generally speaking, the second one would be automation. Like if you're a self-directed investor, if you're early in your journey, or even if you're experienced, just use automated features to your benefit. Like I don't, even as a finance guy, I can tell you the last thing I want to do on my Saturday morning is sit down in a spreadsheet and go over my budget and see where my money needs to go. I'd rather just automate it once and just let it run.
like rebalancing, it's not automatic for us, but the decision framework is automatic.
Yeah.
And then we go implement it.
Yeah, absolutely. So the other one that you had, which was a hypothetical, now I've given my answers here, but I'm going to go for yours first, is what is the weirdest investment you have ever owned?
Outside of a bar,
Which is not weird. It's,
a chicken farm.
did you own a chicken farm?
Yeah.
What?
We still own a series of chicken farms.
Do you really?
Yeah. Or poultry farms. Don't call it chicken because then you relate poultry to.
So you own chicken farms?
Yeah. That's been one of the most successful investments. Probably one of the most successful too. So
What?
like an agricultural property trust
Yeah.
that owns poultry farms.
Ah.
Yeah. Like an old sale and lease back from a major chicken provider where you own the property only, you don't take on the seasonal risk. That would be the weirdest one.
So, okay.
think.
So you,
And
so
maybe
it was the
basketball
underlying
cards?
property. It was the underlying property.
Yeah.
Ah, cool. Okay. Farms, chickens.
I actually didn't prepare for my own question. You couldn't tell from that answer, but it is true.
That's fine. That's fine. We're all happier because you did share it. I've got
You've got drugs? Can you expand on that?
No. I said, so in my notes, I always prepare for these. Prepare so deeply. Spend years preparing for each weekly episode. No, when I was 18 or 19, when all my mates were probably out having a bit of a wild night, I was trying to rack up all the old Pokemon cards that my mates didn't want anymore. So I remember one night I was driving around my old Mitsubishi Magna, like I had this old, it wasn't that bad, but I had this old banged up joint. And I was driving around and I went to my mate, who I know were like big Pokemon card collectors back in the day. And I said to them, do you want to sell these? Because I didn't really have that much of an interest in them, but I knew that Pokemon cards in the future would be worth more than they are today. This is before I knew about investing. I was just like, I feel like this thing is pretty good. And so I ended up spending $250 on, like, imagine you have like a big stack of Pokemon cards someone puts down on the table in front of you. I'm talking like, they would have been like, 30 centimeters tall, like a few different stacks, so just random Pokemon cards. And I knew in amongst that there'd be some good ones. Anyway, I spent about $250 about when I was 19, something like that, 20.
Pre-franking credits.
Pre-franking credits. And I was looking at it, and then I realised the other day when I was going through them, because Kate's telling me I should sell them now, otherwise they're worthless. I have a couple in there like Charizard, which for those geeks like me would know that that's like the card to have.
Sure.
I don't know, you got basketball cards, I got Pokemon cards. Shows like how we grew up. Nerd. so the
Magic the
Charizard,
Gathering, that.
the Charizard's probably like anywhere between $500 and $1,000. This one that I've got.
Credit to you.
Thank you, sir. And I got that as part of the pack, but I also got about $3,000, $3,500 worth of other stuff in this pack. So I did the numbers. That would be a CAGR of about 23% on my original capital, or a 14.
Per annum over how you?
It's about
When you were 19, so what's
about
that,
13
8
years
ago.
yeah, 2 months ago. But it's about a 14 bagger for me. So that was probably the most unusual investment that I'd made. It's not really that, like, collectibles are a pretty well-worn thing. It's definitely the alternative bucket. But I'll give you another one. This was not an investment in terms of like financials, in terms of like human capital. When I was young, like growing up on the farm from like, I would say, I said 9 to 14 in my notes, but it's probably like younger than that, to be honest. Like my parents not forced me, but they basically said like, if you want money, you go and get it, right? And we lived on a flower farm where we sold Proteas, Waratahs, these types of flowers that you get as cut flowers.
Yeah.
Pretty hard work because it was like basically lived on a cliff. So trying to cart all those up was pretty tough. But Mum would drive me up and we lived near this tourist destination. I would go and sell the flowers. And I would bring in maybe $150, $250 cash. Have to pay away a bit of that for my transportation. But this was at the time when my mates and my friends would have been making $200 for 3 days work or whatever, at that time. So I was like rolling in it. And
Buying Pokemon cards.
I basically,
a bit earlier.
Yeah, but this was basically what I was doing is I was like taking something that I had in abundance and then using it and finding the value prop and then selling it. The hardest bit was the imposter syndrome. I didn't feel like I could sell something that I'd created. But then the other thing that eventually shut down this enterprise, kind of like the Buffett pinball machines, but I didn't have the ability to kind of masquerade and say that there's someone else behind the scenes, like a bikie or something like this. Actually, the council closed me down because all the shop owners in the
First
town.
experience with the regulator.
Yeah, that's it. All the shops in the town complained about me because I was taking some of their.
You were selling to their clients. At
Yeah. I was just setting up with my little posies and my flowers, and I was selling it, and I was making good money.
Yeah. And then you're selling to them at 3 times higher.
Yeah, and Big Candy didn't want me to have
like
a slice of their wallet. So yeah, they what do they say? Friction is the best destination for multi-baggers. Well, that's where it was. But that was probably it, mate. So you got chicken. I've got flowers and Pokemon cards. Definitely weird. Okay. First question that we've got today comes from Fashion Phil. This applies to all people that write in a question. You can ask a question by going to your podcast player, or if you're on YouTube, just drop down into the description. There's a thing that says ask a question. Select the Australian Investors Podcast. Drew, Dr. Andrew Derrimouth, or myself will answer your questions weekly. We don't always get to all of them, but we do really appreciate you sending them in and the messages. Bonus points go to anyone that has a funny name. If you are the funniest name of the week we select you, you get a pass to the Value Investor Program. It's about $500 worth of investor training in your pocket for free. Just remember, all of the answers to questions are strictly general in nature. We don't know your personal circumstances. Please see a financial planner like, say, Drew here from Wattle Partners, or anyone at the Wattle Partners team for that matter. Or you can head to moneysmart.gov.au and search for a financial advisor there. Also, if we do mention things like ETFs or whatever, read the product disclosure statement, would you? Okay, Fashion Phil says, hi, Owen. This one's directly to me, but we can both weigh in on this. I'm genuinely considering changing careers from healthcare to finance. Don't know what area specifically, but intend to figure it out as my knowledge of the industry grows. I have explored a master's degree in applied finance as a formal starting point. In your experience, can you speak about some of the pathways or offer any advice in getting into the finance industry, particularly investing? By the way, I'm 38 with 3 young kids, so it is a big deal.
Definitely.
That is a big deal. Drew, what do you think?
I mean, tough question.
It's a tough one.
I mean, the first thing you can do, which is probably what you're looking at, is you're staying in your current career while you're training for your new one. And you can do a lot of the study that you're talking about separate to, like, outside of work hours.
Yeah.
So I think that's pretty important to kind of consider that. But and you'll expand on it, there's so many pathways. I know one, I went into financial advice, and that was basically, it is more challenging now than it has been. You have to have a related degree or an experience pathway. So getting into financial advice is probably significantly different to getting into investments.
Yeah, I think so too.
You almost have to go back to the same, to do a degree as a new entrant now compared to what it used to be in the past. But I think the basic and where you'd start is what you've talked about, and I'm going to steal that, which is the applied finance, to get a basic understanding of the environment in Australia. And then there's so many options. Like, I tried sitting the CFA, but that's well beyond. I think you need 5-10 years experience before you even consider going to that level. And then it's all about annoying people until you get a foot in the door somewhere.
Yeah, that's a good one. Yeah.
So I think most groups will struggle to employ a graduate in an investment position, and essentially you'll be a graduate going into the industry. Yeah. So how do you find a niche and getting your study done first, and then starting to get experience? Maybe there's a link between healthcare and you start approaching
healthcare funds.
Yeah, healthcare funds, or even managers that have healthcare stocks within them, and kind of find a niche within that to get a foot in the door. I think you've got a far better answer than I do.
No, I think that's really good. I think that's a good point. Like, you have a certain skill set, and definitely don't test the water with both feet. It's, I don't know, having to go back and study and do all that again would, just give me the shivers, I think. But if I'm being honest, like a lot of what we are taught is that you should get these qualifications and et cetera, et cetera, et cetera. The problem that you have, particularly with investing, Drew, I feel like, is like 90% of it is just not usable. Like,
most of it just gets you a seat at the table. Like, for most, which is unfortunate. That a lot of the education system is about getting the degree that
tickets,
literally
right?
is a seat at the table, and not actually determines whether your career is a success or not.
And by the time this young we'll say it's a fella, I'll use a male pronoun, Phil, before this young fella gets a job, which is 2 years if they're going to do the masters, maybe 3 if they do it part-time.
Yeah.
We're probably going to see a bit of friction in the industry and a bit of change between now and then. Like the way it's going is it's getting more difficult to get into the investing roles. I think we're going to see a wave of financial planners into the market over the next 5 to 10 years, which will be fantastic. So just in terms of study, I studied active funds, so professional funds management businesses a few years ago, quite a few years ago, maybe 4 or 5 years ago, and there's a link available on the Rask website. Just Google MAPFIN, MAPPFIN versus CFA, and you'll see it come up on the Rask website. And I basically wanted to find out, like, what did people study to get into these roles? And what I found is the Bachelor of Commerce is by far the most common. Obviously, you'd expect that. But the CFA is a role that, the CFA is a qualification.
Chartered Financial Analyst.
Chartered Financial Analyst. It's the hardest one to do.
Global.
Yeah, it's a global thing. It can take you anywhere in the world, basically. In some countries, like, say, the UK, the CFA has pushed pretty hard to make it the default standard of advice giving for investing, which I don't agree with. And then in Australia, however, the Masters of Applied Finance is probably that's what I did. And I did the Masters of Financial Planning with that. I'll explain why in a sec. But that's probably what I'd do. Those two. I wouldn't do the CFA straight away. If you've done a Bachelor of Commerce, go and do the CFA level 1 because it's very familiar ground to you. It'll be hard still, but go and do it. The thing that I don't like about the CFA, well, there's many things I don't like about it. I have a lot of respect for people who do it, but you can expect to spend 1,000 hours of study, honestly. And the people that pass the first time around, because it's not based on 50% or anything like that. It's based on your cohort. Yeah. Whether you pass or not is not based on what score you get. It's what the cohort does. And so they deliberately try and trick you. They teach things in unnecessarily complex ways. Like some of the derivative stuff I found was unnecessarily complex. And I think it's just because the CFA Institute was trying to be original and have their own textbooks and whatever.
I failed all that.
Actually, I didn't mind the derivatives, but I just think it was just ridiculous.
Black skulls.
Like, a lot of the theories that we have in finance are invented by people who need to get a PhD in finance. And then we take that as like the default standard, but no one ever uses it.
No.
And so,
it's all a spreadsheet.
I'll give you some things here. I think like this is the way I would do it if I was doing it again. And I've got a list here, and I apologize if it sounds like I'm reading it off because I am. So,
I can't apologize.
But here's my list. So if I was doing it all over again, this is what I'd do. I would go into the starter pack that I've created. It's on my Twitter bio. It's just takes you through some of the things. Some of it's a bit outdated, but I put together a starter pack for people that want to move into this industry. Just remember, some of it's a little bit outdated. I will update it in the next year or so. Number 2 is I would read the Amazon and Constellation Software letters. So from Mark Leonard and Jeff Bezos, annual letters, go and read them. Just read 1 a week. They're not that bad. Compared to the Buffett letters, which were really technical, like just go and read those. I would read 5 business books before I decide if it's right for me. If I was going to read the investing side of things, this is what I'd go with. The Little Book That Beats the Market. It's the book that might be famous for the Magic Formula. It introduces you to quantitative analysis of financial statements. Very basic, though. The second book is The Last Liberal Art by Robert Hagstrom. It teaches you to be worldly. The third book is not to do with finance or investing at all, but it relates to the way our brains work, which is Influence the Psychology of Persuasion by Robert Cialdini. To give you an idea of this book, Charlie Munger's The Misjudgment of Human Psychology, or whatever he called it, Human Misjudgment, was actually based on the findings of Cialdini.
Yeah.
So to give you an example of how important this book is, Guerrilla Game, Investing in High Technology, if you're interested in technology and fast-growing companies. And finally, there's a book called, it doesn't get much airtime these days, it's by Bruce Greenwald, it's called Value Investing, and it actually surveys like 5 to 10 different investors and their approach and what they have in common. So those are the books that I'd read. I'd listen to the last 5 years of the Berkshire Hathaway annual meetings because that will give you an understanding of how the 2 greatest investors, arguably the 2 greatest investors that have ever lived, deal with these things. Self-promotion, but our Value Investor program is great for someone like this. If you haven't already taken the Value Investor program, just shoot me a message and I'll give you a coupon code to get it cheap. But it's actually applied learning. Follow Brian Feroldi on Twitter. Next one.
Bit of a random.
Yeah, he's brilliant for investment commentary. He will maybe appear on the show again soon. The next one is read for 15 minutes a day for the next 3 months and see if you can do that. I know you've got 3 kids. The Farnham Street blog by Shane Parrish. There's a mental models page. If you just go through them one by one, you'll understand the world better as well as investing. At this point, I would reassess. At this point,
it's 4 years later.
I would reassess. This is probably 3 or 4 months in. At this point, I would reassess my life and where I want to go.
What if someone recommended I do?
And then I would go, do I still want to continue down this path? Because you've probably learnt a lot of the major nuggets of wisdom from our industry. And the next steps is to your point, I would take the Kaplan Masters of Applied Finance. The Macquarie one is the better, higher standard one, but you got to study on Saturdays is my understanding. Maybe there's an online option now.
Yeah.
But I want Saturdays in my life. So maybe you do too. So the Kaplan one you can also marry with a Masters of Financial Planning. I'll get to that in a second. But you can also just buy the CFA textbooks rather than doing the course. The CFA textbook that I think would complement the Kaplan course is the Financial Statement and Analysis textbook for someone that hasn't done finance before, because it will teach you about accounting principles.
I've got a copy at home if you want it.
Get a signed copy. Just says good luck on the inner cover. So I would, if I was in the finance industry, this is where I want to tie in with you. If I was in the finance, if I was thinking of contemplating going in the finance industry, I would definitely study financial planning in some way, shape or form.
I reckon it's a good entry, like being face-to-face with a client, and then you're actually exposed to all the parts of investment, all the parts of the industry, which is good and bad. Like every day we have fund managers telling us, what macro outlook is, what type of funds, and how do you build portfolios. So, yeah,
but if you think about it, even if you think about like this is what I made that comment to you a few weeks ago. I was like, most people in finance don't actually understand finance.
No.
Because at uni, we get taught about like efficient portfolio calculations, not like, and this is what superannuation is. And did you know inside super, it's just ETFs and managed funds?
Yeah.
Well, that's what it is. And here's what a managed fund is. You don't really get taught that stuff. You get taught like all these calculations based on finance theory that you never use again because the computer does it for you.
Supply demand, econometrics, medians.
Yeah. Oh, Excel, trend line, thanks. Like I'm being realistic here. Like financial planning is more worldly.
Yeah.
And I think every finance person...
spread. You end up doing insurance, super, investments.
Absolutely. How it all connects.
Yeah.
You should have at least, everyone that does a finance degree should have at least a minor in financial planning. And so I would do that because you'll, at the very least, even if you hate the course, at least you'll know how to manage your finances. So that's what I would do. And I think that also prepares you for a future where investment markets and jobs in the investing industry might be extremely hard to come by. Don't you think? Like, I feel like they're going to be harder to come by in the future. I'm sorry to put anyone off. Like the jobs that people want today.
I think AI is taking over a lot of jobs whether it's in research or whether it's in analysis as well. There will always be people required to kind of run those systems. But I mean, most of the wealth management forward-looking white papers suggest there'll be 20-30% attrition of wealth managers in the next 5 to 10 years. So
yeah, it's kind of like what online broking did to stockbrokers.
Yeah,
right. Like they still exist, but.
And I think it's probably more accessible as an older graduate getting into advice than you probably are in investments.
People would be so grateful to have that experience outside of finance.
Yeah.
I think that's one of the key advantages that someone like this has. Finally, the number one piece of feedback that I always have for people going for jobs in this industry is do something out of the ordinary. And the easiest way to do that is to start a Twitter/X account and interact with people, to start a blog, but do not give financial advice. Do not go out there and be like, buy, hold, sell, but just write and journal what you find. Like, oh, well, I researched this company and it does this. This is its business model. Then I looked at this company and did this business model. And then follow the fund managers or the financial advisors that you like and just interact with them.
Yeah, exactly.
That's the way to stand out, not through a different degree.
Go turn up at events and annoy people. Ask questions.
Yeah, that's it. Yeah. Just be that person and get noticed. And that's what would be the number one piece of advice. Bit hard when you got kids, but just do it and learn. Yeah. So that's it. So this is a good one for you, Drew, because I didn't really know the answer to this next question. It's from
I will.
Maybe. Hopefully between the two of us, we can come up with a 4 out of 10. Takeaway family pack for one, please. That's the name of the questioner. It says, hi, Drew and Owen. I was not surprised when you said one of the common questions on your roadshow was on investing as a couple or getting your partner to save and invest. It is indeed. So can I ask you the opposite? What should singles be doing to get a leg up in investing? It seems like everyone's geared towards families. No super spouse contribution, no way to invest in a lower earning partner's name, no tax breaks for singles, no expense sharing, e.g. like rent mortgage. Is there anything singles can take advantage of? As long as it is not finding a partner, I'd appreciate some realistic general advice, please. What options do singles have?
I mean, there's some family benefits, and that's like the income streaming. But most things are, I think, most structures and superannuation, all the other things are still available to singles. I think there's nothing outright, and there's definitely a subsidisation of families in multiple different ways, whether it's in the form of childcare or not.
Yeah.
But I think it's incredibly difficult. Like even renting, a single rental, a single income trying to rent at the same time is incredibly difficult. So
yeah,
I'm not.
Especially if you've got dependents.
Yeah, exactly. We said no dependents here.
Yeah, I'm assuming no dependents here because they haven't said anything about family. They said everything's geared towards families.
Yeah.
So.
All you can do is try and get started and take the right steps and invest aggressively.
Yeah.
My accountant often tells me, when you're trying to find interesting deductions, just pay the tax. It means your income is going up.
Yeah.
Like just accept that you can't hide it in different entity structures or get extra, deductions here and there. Just accept that that's the guardrails or the guidelines, and then just as you've always said, automate as much as you can. Invest aggressively, use structures that are available to you because superannuation's treated the same as everyone. Yes, you can't switch contributions around. And it's, I know what you're going to say first, but that's a pretty tough one to start with too.
Oh yeah, get a better job. I've conjured my inner Charlie Munger
there's
for
another
that.
one there, which is like if it's income driven, you need more income. Well, maybe it is that side hustle. Is it? I hate talking about it, but are there other, there are different things you could be doing on the side that can bring in an income that you can direct towards investments? Is it consulting? Is it, selling things online? Is it drop shipping? Is it, no, don't do any of these things. But is it creating an app? But that's kind of how do you find additional income sources rather than how do you deal with the end of the funnel?
Yeah. I mean, just thinking out loud here, I think the one thing that folks would have if you're a single without dependents, this is my key asterisk because we don't know. Without dependents, you probably have more time than someone who has dependents or is in a couple. And I'm just being realistic here.
Yeah.
On average, you probably do.
Yeah.
Sure, you might have a wonderful social life, but for the most part, you probably have more time, which gives you more flexibility.
We're grossly
generalizing.
Unprepared to answer this question.
No, but I feel like, so I think about this a lot because I get a lot of pushback on this saying that I have is that the world is built for couples. The finance world is built for couples.
Yeah.
And people do tend to push back. They say, hey, I'm single. And I hear you. But it is built for couples. I'm just acknowledging the reality.
The thing is, you can probably accept more risk.
You can accept more risk. You probably don't need as much as insurance.
Yeah.
That's probably the big thing. You'll still need some insurance, but you probably don't need as much because you're not worried about that sort of thing.
Yeah, so you can go hard. Like if you're buying a property, you can probably be comfortable leveraging more. You can probably take more risk. You can probably take a longer term view.
As long as you have insurance.
Yeah.
Yeah, as long as you have your emergency fund, these types of things. The other thing is, you mentioned that you can't do like mortgage and shared expenses, but maybe you can. What I mean by that is maybe you can do a flatmate situation. I'm not saying forever, but so like, if you own a house, maybe you can rent out a room or get international students in, and therefore you end up with a situation where some of your expenses are costed out. If you're renting, maybe you can find someone that will share those costs with you for a limited time.
Yeah.
While you, for example, study to try and get a pay rise or move through your career. Another thing that you can probably do, which is at your advantage, is, and I'm just trying to be realistic here, is you may be able to do more things like overtime. And you said side hustles, these types of things. Those are things that may be possible for you.
And the end piece is just invest.
Everyone's got to invest.
We're talking about how do you maximize your income to do that.
The harsh reality here is the big one, the big rock in the room is something that is undeniably difficult, which is property.
Yeah.
It is so bloody hard to buy a property, even as a couple, let alone as a single. So you in this instance, don't know circumstances, but you almost certainly will have to compromise on location, on quality, on a house, maybe it's an apartment, on distance to work, these types of things. We're generalizing here, but one of the things that you may be able to do is you may be able to work remote more than in the office or something like this. You may be able to buy a property without having to cater for kids.
Well, there's a good article, I think it was on Animal Spirits as well, Wealth of Common Sense, that said there's like 100, I think there's multiple cities where you're actually better off renting.
Yeah.
Given the cost and impact on your income.
Yeah, absolutely.
That's in the US.
Yeah. And let's be honest, financially you can be happier as a single. There's no question. You can. You can be strategic in the way that you work, in where you work. You have more flexibility and autonomy around where you live. You probably don't need as much insurance, although you should still have some. I'm going to keep iterating that point. You also can set your own goals and priorities.
Yeah.
Whereas in a relationship, you often have to compromise on goals. You also have to compromise on the other person's bad habits with money.
Yeah.
So there are a lot of things that work in your favor. It's a hard one, but I would say, if you just think about property as the big rock, they say 4 to 5 times your income is what you can borrow. So that's probably your upper ceiling in terms of the property accessibility question. And that's where I would go with. But I hope that's added some cost. It's just try and find a negative and turn it into a positive. So, okay, I can't save money on rent. Well, why can't you? Maybe there is a way to do that. Maybe there is a way to get someone in or rent with someone else. Maybe because you don't have the extra income, maybe you can invest more in your current career to get ahead faster than the person that goes and has kids or goes overseas or meets a partner and is distracted from work. That's your opportunity, not your weakness. Anyway, let's get on.
Not that partners are distractions from work.
Not at all. Definitely not. Sophia from the UN says, this is coming to you live from Sophia. She's now in my brain. I am in my 40s. I thought Sophia was ageless. This is a bloody great question, actually, Sophia. So thanks for sending this in. I'm in my 40s. I've been on the FIFO bandwagon, fly in, fly out. No, I don't think it's first in, first out. I don't think it's an accounting standard. CFA charter holders will get that joke. No one else will care. I've been on the FIFO bandwagon for nearly 20 years. I've paid off the house, bought a bunch of toys, cars that have actually gone up in value. That's interesting. And I'm debt-free. I've loaded up my super over $450, I think it's meant to say $1,000. And I'm now loading up the share portfolio, including ETFs and individual companies. What's next? How do I set myself up and my family for the future so that I can escape the FIFO trap?
Don't stuff it up.
Don't stuff it up. And end of podcast. Thanks.
Mic drop.
No, but this is a true thing. Anyone that lives in Adelaide or Perth in particular will know you go to the airport and there's hundreds and thousands of people lining up, fly in, fly out, Virgin and Qantas making it their jam.
No, you're doing 100% the right thing, which is just adding money to set up passive income streams that will take care of you for the rest of your life, essentially.
Yeah.
One would be, if you're not getting advice, get advice and find out how much you'll actually need to live the lifestyle that you want.
Yep.
And then you'll get to a point, that's what we do a lot, which is so many people come in with more than enough than they need and hate their jobs, hate not necessarily fly-in flight, but all kinds of careers. And then once they realise that they've got enough, work changes. You don't find it as stressful and you have more freedom and you enjoy the rest of your career. So it's finding out what that dollar figure is. Then you've got a strategy to work to. If you're already there, well, that's probably the more challenging question is what do you do then?
Yeah, what do you do next?
And maybe it's a career change. But basically you're in a strong position. And when we say don't stuff it up, we're serious. There's many ways to stuff it up. Tax-driven investments. You start thinking about saving tax rather than the quality of an investments. Taking on too much, leverage, doing things that
investment properties.
Exactly.
Yeah.
Just adding, just the small things that make sense generally, but when you're in the context of the moment, tend to be forgotten. I mean, leverage is a big one.
Yeah.
And that's a big form of risk. Why take more than you need to?
Yeah. Get advice now would be that's probably where I should have started. But I actually thought, here's my simple but not easy answer, is just start living the life you want.
Yeah. Because
I'm assuming, they said, set myself and my family up. If you've got a family, I don't know about anyone else, but my preference is not fly in, fly out.
Yeah.
I wouldn't want to be away for, let's call it 7 out of 14 days or whatever the situation is. So I would be assessing right now, either with a financial planner and your partner or just by yourself, it's literally sitting down right now as you hear this podcast, what life do I want to live? How important is spending time with my family? And does my job meet that requirement? Because you are now at a point where you have not complete financial independence by the sounds of it, but you're very close to it. So you probably don't need to continue down this path for very long to live the life you want to live now. And if you don't have debt, one of the beautiful things about not having debt is you can go, well, I'm not going to work this job anymore. I'm going to go take half the pay, but live the life that I want.
Yeah.
And that might not financially be the golden rule. It might not be like the golden opportunity that you have, but that might not be that important to you. What might be important to you right now is if you're in your 40s, kids might be in their 10 years old in their early teens, being there for them.
Exactly.
So I think it's great to get to where you are, get some advice, or just sit down and reflect on this by yourself, with your partner. I would set myself a goal if family was really important to not be in FIFO within 2 years.
Yeah.
Go and gouge as much money as you can from the mining system and then get out
and
find something else.
Exactly.
Yeah. Great question, and good on you for getting that far in. Colin Davis, want to get Rask portfolios, says, hi, I finished the ETF beginners course. That was the question.
Now leave a review on Google, please.
Yeah.
I'll do it for you.
Yeah. Now, that's congrats, Colin. Please now leave us a review on Google. But share the love and give back to the communities around you. Thanks for shouting that out. Colin, if you did complete the ETF beginners course, write into us. We'll give you a pass to the other courses for free. Well done to you. So one final question here, Drew, comes from hard times equals hard men. Easy times equals ... entitled kids. So the question is a wonderful one, which is something we've spoken about with Jamie before. If someone wanted to invest in 2 ETFs that tracked 2 indices, just like the ASX 200 or the S&P 500, for example, and hold on to these for life, then pass these on to their kids to then hold on to for their life, what would need to be considered with the handover from father to son and daughter? For example, tax or transfer costs. Besides education, are there any strategies you would suggest to avoid creating little entitled buggers?
Don't give it to them.
Yeah, here's one. Give it to us.
I mean, it's just open conversations about money. Isn't it?
Yeah.
Like, you can answer the tax question. That's pretty straightforward, which is when you transfer it, you're going to have to pay capital gains tax on that transfer. There's other options, like some people use an investment bond, which we've probably talked about before, which is a tax-paid entity. You can put in their name, but then they get taxed punitively. But I think in creating them, it's having more open conversations about money, whether it's with partners or with children. So, like, the amount of people we meet that don't understand the level of inheritance, like the wealth that their parents already have, or the position that they're in. So it's that's not education, that's just transparency, I think.
Yeah. I think I'm going to push back on one point you just said there, actually, which is that I think you can transfer to the children assets if they're held in their beneficial name. So just the legal owner changes. Get tax advice. But I think you can set it up so that basically the shares are held
trust structure.
Shares are held on trust for the child, but you're the legal owner, so you pay tax until they come of age, and then you do the
tax
transfer.
on income, not on capital gains.
Yeah, because then it's just a legal transfer, not a beneficial transfer.
Yeah.
So that's one way, but definitely the insurance bonds for people that are wealthier. That's probably the next
tax-paid entity.
Yeah, that's the next way to go. If you're on a farm, there may be different benefits for you too. So that's something. But Scott Pape in his book Barefoot for Kids basically says that one of the key criteria for kids is to earn it. Like, they have to earn the money.
Yeah.
Easy come, easy go. Or in this case, hard times equals hard men. I guess. I think that's a quote. Was that? I'm going to get this wrong. Was that Kerry Buck?
No, I thought it might have been Shawshank Redemption or something. I'm not sure.
Shawshank Redemption.
No, The Green Mile.
Forrest Gump.
Falling flat here. We can't reach the noise.
Yeah, it's too far away.
Yeah.
So I actually heard a really interesting story of someone recently who got given shares. They were told, they were educated about investing as they were teenagers and as they became adults. And they got given shares between their 18th and 21st birthday.
Yeah.
And the father in this instance said to them, "You're never getting another cent. This is your money. This is the only amount of money you will ever receive." Think about that. And that child, because they'd been educated on investing, they kept investing.
Yeah.
And they actually used that money as a bit of a buffer to then go and freelance for the first 2 years of their career after they finish school. So not going straight into a career that they might hate, but actually freelance to figure out what they wanted to do. And it actually allowed them to start a business, which they loved. And so is there a way with your child, if you are setting them up in this way, to not just educate them, which you said, but the other thing is to make them feel responsible and grateful.
For what they get.
Yeah. Because unless they have some skin in the game, they're just going to, most of them, not all of them, it's generalization, but I haven't, there's all the studies that show after 2 generations, money's basically gone.
Yeah.
It's because the most important thing, like Jamie would tell us, is to pass on the education. And you always say, connect with them on their level.
Yeah.
So,
I mean, my 2-year-olds know how to spend. They don't know where it comes from yet, but they're more than happy to tap away at the coffee shop.
Yeah, my sister invested in VAS, VAS. That was her choice over. That was that or the S&P 500. She chose VAS. Good on her. And so what I'd say is, like, if this is the case, you need to educate them on the path to it, but give them that responsibility. Let them know that it's not going to become easy. It's not going to be easy come, easy go. Because, I mean, their balances will be going south of the border as soon as you give them the money.
Yeah.
So don't let that happen. And teach them the value of money. I think what I've realized in running the Australian Investors podcast and all the podcasts over many years is that when we get people to tell their stories, there are very common elements. And one of them is this, Drew, and you may have experienced this too with your parents or what have you, is that children who tend to see businesses play out in real life are more likely to go and take risk and start businesses themselves. And that's not a coincidence, I don't think. We see that entrepreneurial spirit early in life, and they see the role models do that. Yeah, that's what they'll emulate. They're just like
for better or worse,
sponge, right?
Yeah,
may not happen all the time, but that's what I would do. And I'm sure if Jamie was sitting here right now, last time we had him in on a Q&A, he was just into the out of the fire into something like that. He was in the frying pan anyway. He was saying that it's easier to educate kids on business, not on investing.
Yeah,
and so if you think about like the lemonade stall examples.
Concept of business doesn't make sense.
Yeah.
I mean, investing doesn't necessarily make sense to young
business
people.
would.
Yeah.
Lemons come in, lemonades go out, money. Right? So that is the concept you should be trying to teach them at any age. And that's where I'd say to go to. Get advice around the tax structures that you want to sort out. Like confirm both Drew and I's opinion on this with a tax accountant or a financial advisor, say like Drew. And then go your own way. I just think it's really important to teach your kids. The life goes on, and you've got to manage the money appropriately.
Exactly.
So, Drew, I'll select the questioner if you have the dad joke for us.
I'm ready to go.
Okay, I will give the award this week. I just love this question, to be honest, which was the question from Takeaway Family Pack for one, please. You said how hard it is to be a single in the financial world we live in. Well, here's a free Value Investor program for you that will help you on your way. Same with you, Fashion Phil. Give you a second. We'll give it to you as well because I mentioned it in the answer to your question. It's a good course, and I think it will be very beneficial for you in healthcare switching across. Without further ado, you can get in touch with Wattle Partners via wattlepartners.com.au. There's a link in the show notes. We will be in Sydney next week. Dr. Andrew Dermuth is not banned from travelling to New South Wales yet, so he will be in attendance, as will I, and as will a wonderful lineup of guests in Sydney. Tuesday night after work, it's a school night. It's not going to be too wild. It's going to be a bit of fun, says Drew, as he kind of like nods his head a bit weird to the side. Oh, are you sure about that? You sure about that? Come and say good day. Then the Wattle Partners events on the 26th of October. Almost sold out. Free event for retirees over 45. Come along. Drew, take us off into the distance with the joke.
Sticking with finance.
Ooh.
Where do fish keep their money?
Don't know.
In a riverbank.
Does that even make sense? I like it, mate.
Thanks for listening.
Thank you for listening. We'll just leave now. No, mate, I give that's a good solid 4 out of 10.
All right, I'll take that.
Well, it's nearly a pass.
The normal one. So.
Yeah. Well done, mate. Thanks for joining me.
Good to see you.